Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. For the third year running, earnings of Australia's largest companies are set to shrink this earnings season, with Morningstar predicting another 1% contraction for the ASX 20. For many companies, current stretched valuations don't really reflect the growth outlook, but there are still opportunities in the market for investors. Of course, the information in this episode is general in nature. It does not take into account your own circumstances. You should do your own research and seek professional advice before making investment decisions. Lochlan Halloway is the equity market strategist at Morningstar. Lochlan, welcome back to Fear and Greed.
Thanks for having me, Sean.
So, what are you forecasting this earnings season? It kind of kicks off in the next couple of weeks.
Yeah, look, it's going to be another fairly muted year for earnings growth from the ASX on our reckoning. We're looking at a 1% decline in earnings. That would be the third straight year of falling earnings for the largest companies in the ASX. The top 20 account for about 2/3 of all earnings on the ASX, so they're very much a bellwether for the broader market. A big part of that is the mining companies coming off the highs of the post-COVID commodity boom. And the other large sector on the ASX, the banks, don't nearly have enough earnings power to account for that loss. So another fairly modest year, and we'd probably argue that the outlook isn't all that much more exciting either.
So we'll get to valuation in a moment, but what is the outlook? You said it's not that exciting. Why is that?
So we're still expecting further cooling off in our earnings amongst the energy producers and the big miners. For the banks, we're looking at low to mid single digit earnings growth. Again, not enough to offset the slumping mining profits. We're expecting 2% nominal earnings growth in fiscal 2026 and 27. It's probably going to be sub-inflationary, so in real terms, that means earnings going backwards again for the foreseeable future.
So explain to me then, Lochlan, why we have a market trading near a record high with the banks doing particularly well, having mentioned, they have come off a little in more recent weeks and the miners picked up. But why is our market doing so well if the outlook is that poor?
Well, it's something of a puzzle from a fundamentals perspective. The recent weakness in earnings is kind of in the rearview mirror, and of course markets are forward-looking. But as I mentioned, the outlook isn't all that exciting either. For something like Commonwealth Bank, mid-single-digit earnings growth, which I think is a reasonable assumption and broadly in line with what the market thinks, that wouldn't usually justify a price-to-earnings multiple of 30 times and a price-to-book of 4, but investors seem willing to pay that much, notwithstanding a recent pullback in the case of CBA. Well, there have been plenty of explanations offered as to why these blue chips have run so hard, flight to safety, their quality names, passive money, international fund flows, super, you name it. These are all sort of technical, non-fundamental reasons, and they might be supporting share price of these stocks in the short term. In the long run, we think the valuations and the fundamentals are what matter most.
What about the big switch? And I don't know whether that's probably not the right way to call it, but in recent weeks, outside ANZ, the other three major banks have gone backwards. The miners, particularly Fortescue, but also the healthcare companies like CSL, have done very well. Do you think that investors the big switch is on, or it's something else?
Well, I think certainly short term, it's fair to say we've seen a switch. The banks, broadly speaking, have retreated. We've seen strong flows towards the miners around sort of sentiment-driven stuff to do with that big mega project announced in Tibet, fueling optimism around iron ore. Whether this is a sort of sustainable, rotation or switch is a bit harder to tell. Back in February and March, we saw something similar happen, and a lot of analysts were saying, well, this might be the start of the great rotation. It wasn't to be. Commonwealth ended up surging to a record high not long after that. So, look, we're not, I suppose, in the business of calling, is this the rotation? Is it happening now? Is it going to happen in a few months? But certainly, again, from that fundamentals angle, there's a lot more appeal in miners right now than overpriced banks. So in the long term, that should win out.
Okay. What about as we go into earnings season? I'm not talking about specific stocks. We'll come to them after the break. But what are you looking for and what are analysts looking for? Will there be a lot of commentary about rates, about tariffs and the effect they have, about international economics? What are you looking for?
Look, I'm sure almost every call will involve something to do with tariffs, particularly for those globally focused businesses. That is the topic of the year, and it's still largely unresolved. So we'll be looking for that. I think the other thing too is going to be ongoing cost pressures and inflation. It's kind of taken a bit of a backseat recently, and good to see with the Reserve Bank having largely got inflation under control. But certainly there still are some pockets of the market that will be facing cost pressures, particularly on the wages side, which haven't cooled off as much as broad inflation has. So we'll be looking there too. But I mean, certainly it's very hard to make short-term forecasts, particularly for globally exposed businesses, with so much uncertainty there around geopolitics and trade.
Stay with me, Lochlan. We'll be back in a minute. My guest this morning is Lochlan Halloway, equity market strategist at Morningstar. We kind of went through the big picture ahead of the break. Let's talk about some of the stocks that you've nominated that are worth taking a look at. Starting with one of my all-time favourites, only because I did some work for them many, many years ago. And ever since then, they seem to have gone worse and worse. Domino's Pizza.
Yeah, look, Domino's, it's a bit of a contrarian one. It's very much an unloved stock on the ASX, which is a complete contrast to where it was, say, 3 years ago when it was on a PE of 60 and was a high-flying market darling. That's completely changed now. I mean, the frustrating thing with Domino's is recently, of course, that we saw another bout of turmoil in terms of management with Van Dijk announcing he'll leave the business at the end of the year after a fairly short stint at the helm, and before he announced a much-awaited strategic update regarding the outlook of the business. They did some rationalising and some cost cutting, which was good, but we do want more clarity on the outlook. Nonetheless, we still think that Domino's, is an attractive and compelling investment opportunity, because at this point, you really don't have to assume anything about growth to make the investment case work out. It is priced basically for no more stores and no margin expansion here. So even modest improvements in terms of the store rollout and a cyclical recovery in store profitability should hopefully see that business re-rate to appropriately higher multiples.
What about Ramsay Health Care? It's a stock that has had a rough few years, although in more sort of recent weeks/months, it's done a bit better. You also like it?
Yeah, that's right. And the story there in terms of the earnings outlook is mainly driven by cost efficiencies and a reduction in cost pressures. Ramsay's obviously been subject to a fairly significant squeeze in terms of margins due to wage cost increases, but we see that coming out, and when we get a recovery in activity, that should drive operating leverage and above market EPS growth for that business.
Okay, what about Bapcor? Tough end of week last week where it downgraded its outlook and its share price. It was sold off pretty sharply.
That's right. Look, that was a really tough trading update. Conditions were weaker than we expected, and obviously the market had expected in the retail business and its specialist business. The turnaround's probably going to take longer than we anticipated, and perhaps the long-run outlook for margins, is not as rosy as we once thought. That being said, we still see the turnaround story there, and it's the trade business, which is really the best part of that business. It is really what drives our view, and that's where we see the focus in terms of the eventual margin uplift. And in terms of rationalising other parts of the business, I think strategically management's on the right track. That business, when it turns around cyclically, should start to shine again. So we still see an opportunity in Bapcor. And once again, like Domino's, it's really not priced for that much at all.
Okay, Lochlan, what about IGO?
Yeah, look, IGO, obviously that's the lithium play. Lithium as a commodity has been on really a bit of a tail slide for the last few years, coming off that sort of price boom we saw in 2022, and conditions across the industry have been tough. We've seen, excess supply creating depressed pricing environments, and many lithium miners in Australia are, producing below the current price of lithium. We do see that market gradually starting to come back into balance. We're seeing some curtailments from both the sort of Western producers in Australia and also, importantly, some of the producers in China who have been producing uneconomically and keeping prices depressed. The fact that that's starting to come out of the market should help bring things back into balance. And if that plays out, and it's starting to play out now, that should, lead to a recovery in lithium prices and a recovery in the share price of businesses like IGO.
Yeah, on that, I mean, lithium, because it has bounced a little, the price of lithium has bounced a little, and part of that is on a crackdown on illegal lithium mining, and as well as other commodities in China. I don't quite get that. Is the Chinese authorities just getting a bit tougher around that stuff?
Look, I think it's probably more about making sure they have a managed grip on lithium production. They're obviously the world's biggest electric vehicle market, and they are producing, or they have encouraged their vertically integrated battery producers to keep mining, below, when the price is below cost, so that they can keep supply up for the downstream battery manufacturers. I think, again, what we'd say is that China doesn't have particularly high quality and particularly large deposits of lithium, and eventually that's going to run out. And when that does, we should see, some of the supply coming out of the market and prices being more or less brought back into balance, which we estimate is about $20,000 a ton for lithium, and prices today are about $10,000 a ton. So, we're looking at sort of a doubling of prices by mid-cycle as these supply pressures start to come out of the market.
Lochlan, we are out of time, but just quickly, SiteMinder, that's been one that you've liked for a little while too.
That's right, yeah. We think it's a highly winnable market for SiteMinder. They're obviously for booking software for small and medium hoteliers. We see that as a really winnable opportunity for them. They're not profitable yet, but we expect them to be in the next few years, and they're one of the other growth names we've called out on our best ideas list.
Lochlan, thank you for talking to Fear and Greed, and enjoy earnings season.
Thanks for having me.
That was Morningstar equity market strategist Lochlan Halloway. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.